I'm Mike Feiner from Feiner Wealth Management. Welcome to the February 2016 taping of Feiner Investment Watch. The big story this year has obviously been the precipitous decline in the stock market. Beginning the first week of January, the market went south very quickly as a result of declining oil prices and a lot of trouble in China. That persisted through the end of January to where we had one of the worst Januaries recorded. February started out with some improvement, and now that we're in mid-February during this taping, we've had a rebound a little bit in the stock market, yet as of mid-February, the market is still down anywhere between 5 to 10%, depending on which part of the market that you follow. Why is this, and what does it matter to clients of Feiner Wealth Management or to you in general? Well, we still believe that the underlying U.S. economy is very stable. Corporate profits have been reasonable. And the stock market typically over time correlates and reacts to good corporate profits. Certain parts of the market, though, have been very weak. That includes banks, some big technology, biotech, and of course, different oil companies. At Feiner Wealth Management, we've pretty much been focused on consumer staples and on utilities and some very defensive investments. So we still believe for the next 6 months that those are the sectors that will perform well in this environment. The international environment has been tough for a variety of reasons. Most importantly, because of the perception of a weak China, because of dislocation of different oil-producing countries' economies such as Venezuela, Saudi Arabia, Brazil, even Russia, we're still going to have increased volatility in our markets. Combine that with the fact that the Federal Reserve is still looking to increase interest rates in this environment, and that they've taken off the quantitative easing and stimulus, we can expect very volatile markets. In fact, we expect there to be a strong end to February and into March. We expect there to be volatility and potentially a sell-off in April, with a recovery in the summer. So with that, we have to be nimble and think about buying when things are low and selling when things are high. Going forward, there are other things to think about. Interest rates are actually lower now than they were months ago, despite the fact that the Federal Reserve has increased interest rates. With that, we expect increases in mortgage applications, which will help the economy. The housing market is still strong. Employment is still strong. Inflation is low. Corporate profits, as mentioned, are good. All of that should combine for the U.S. domestic market to be positive for this year. We don't expect the same necessarily for international or emerging markets. We expect that the U.S. market will be the leader this year for a lot of these reasons. Combine that with the election, which has been quite interesting and quite entertaining. As that sorts itself out, we expect there to be some certainty as to at least who the major candidates are. But with the election season and all the negativity that tends to go along with that, starting more definitely in August, September, obviously October and November, we expect some additional volatility. But once the election is over, we expect some strength at year end. With that, we hope that the increased oil dividend will help the U.S. economy tremendously. I actually just drove here this morning to see gas prices at like $1.59 a gallon at one station, which I couldn't believe. I pumped gas over 30 years ago when I was in high school, and gas prices were higher then than they are now. If you consider the fact that the U.S. utilizes 400 million gallons of gasoline a day, just as an example, you'll see that that's a lot of money in our pockets. And that will help the U.S. consumer, which drives 75% of our economy. Combine that with the fact that the U.S. now produces over 5 million barrels a day in shale oil, which we don't have to import, and a lot of that money stays in the U.S. economy. Because oil prices have declined so rapidly, there has been dislocation in different states like Texas and Montana and North Dakota and other parts of the oil-producing economy. Overall, though, that will be good for the U.S. economy as things even themselves out to some sort of equilibrium. So our bottom line is we are focused on the consumer staples. We're actually buying some integrated oil investments to take advantage of buying low and eventually selling high. And we're also focused on healthcare, which we still think is an excellent investment for 2016 and beyond. If you have any questions, please feel free to reach out to me directly at michael.feiner@feiner.com. Please feel free to look at our website, www.feiner.com, or www.feinertv.com if you'd like to look at this video or other videos and other television shows that we are part of. If you'd like to give me a call, please feel free to call me at 978-740-1011 at any time. And you're welcome to follow me on Twitter, and I am @Feiner_. Thanks so much, and we look forward to seeing you at our March Feiner Investment Watch.